There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Right. Now, I haven't shown these charts in a while. At the top, we've got equity markets, and then at the second row, we've got European markets. The only really thing to understand in this is that the markets have had some pretty significant correction, and they've retraced close to 50% of it in almost all cases, with the exception of NASDAQ, which has been a lot weaker, with the exception of the small cap. So for those looking for Forex, I notice a lot of our new subscribers are actually trading equity-based Forex pairs or just contracts. I think it's always important to know what goes on inside the equity markets first, because currently they are the dog that's wagging the rest of the tail of the world, including currencies to a large degree. I've talked significantly and at length on many of the Saturday calls in January about all of the issues that have befallen. Do take a look at, if you haven't seen it, this is my Telegram channel here called Market Watch. I have put up a lot of stuff on this channel that you can see how many of these are just notations, but you can always go into the channel itself. Just click on the three dots and you're viewing it as of myself. You can always click on the channel, then click on the photos, including files, what have you. I've shared a bunch of different links and so forth. But the key thing with the photos is you want to focus on all of the education that I've uploaded. So skip a lot of the notification pictures. This was my most recent post. Hopefully you guys can see this. I follow a lot of guys on Twitter, and you guys can certainly follow me at fxestrader.com. But the key thing to understand with a lot of this is that there are, I'd say probably about 100 people on Twitter I follow. A lot of them are really good educators. In many cases, they run large hedge funds, large chunks of money. They are quite generous with their views of what's going on, sticking mostly just to the macro view of how central banks have been changing money supply and how they've been changing a lot of their theory. A lot of the quantitative tightening, which is a new term, is the opposite of quantitative easing. So essentially, they are attracting or expecting to retract liquidity from the marketplace, which is the complete opposite of providing tons of liquidity to the marketplace by essentially buying up all kinds of assets, mostly just to treasuries and open market operations, thus putting chunks of cash into primary dealer accounts around the globe. Hence the big run up in asset prices across almost all categories. And that has been exacerbated recently by inflation. So just talking about some of the key messaging in Powell's post-meeting press conference was this tightening cycle, right? And that's something I've been talking about for, I don't know, a couple of months now, but starting to get a little more color in the marketplace as far as this. And there really is an idea of just isn't going to cause an economic slowdown is fantasy. So the first order of effect is reversing the easing monetary policy and then reducing prices. So follow Scott. The reason I wanted to post this is that the problem with this whole move on the Fed is, one, it's never been done before, and two, as he says at the bottom here, the Fed's trying to do something that's impossible, but essentially not shock the market while being an aggressive inflation fighter by trying to pull back um, in the form of reducing liquidity. So that is the market watch. Tons of other charts up there. Let's move more into the FX space. So do note, as I think it's important, from everything mortgage rates to buying stuff to rates on your cash sitting around your bank, right? A lot of the prices for most of these notes and bonds have all dropped, so the yields have risen. So the yields on money markets may have gone up a little bit around the world, depending. Most of our subscribers view all markets globally, but I think you want to take at least a cue from some of that. So what has been interesting, though, and this is, we're looking at a daily chart here. Remember, if you're in FinViz, always check to see that you're on the daily charts all. That way I can see the dash comparison. But what is interesting to note is that maybe you can't see the correlations that clear, and it's typically more evident in a longer term bond. But see how prices of the bonds, especially in the 30-year, maybe a little more prevalent, obviously, in the 10 and 5, but see how prices have come down, thus pushing yields up. Look at the effect it's had on the dollar. It's almost been trading in tandem, or in what they call correlated movements. Thus, and this 97.50 was a real big area in a long-term chart, but as soon as we hit it, we dropped the full dollar. And this has just been, what, 1, 2, 3, 4, 5, 6 days. So I'd say most of our trip to Florida, it's been an absolute reversal off that, hence a rip up in the euro. To look how easy it is to just spot this support point, right? And almost everything, obviously off of this reversal, which sort of been stalling out for the last couple of days, but was in a big downturn. You've had a big lift, obviously, in the euro, right? And GBP, but you haven't really seen it to a large degree in the Canadian. It's just sort of stuck in, a sideways trade here. And I think that, honestly, I'm pretty sure this reversal is due to a myriad of factors, but the decoupling effect of the US dollar from bonds, from central banks, has just us trying to read these charts through sort of the darkest, muddiest waters, and that makes it really tough. So it's probably almost a good thing we took a good week and a half break, and just did a family trip to Florida. And luckily we didn't die in a car crash. But the movements in all of these currencies, and there isn't really a lot of news this week, which I didn't go over on Saturday too much, but and I think we had some problems uploading the stream because I get this new OBS on the laptop here, but my fault on that one. I'll take full credit. Hopefully we got the stream figured out. There really wasn't a lot of news the last couple of days. Obviously coming up, Canadian, we've got Governor Macklin speaking, then obviously Bailey speaking in for the Bank of England here. Holiday all day in Japan, and obviously nothing going on. So surprisingly quiet week in terms of central bank, as opposed to last week when there was all kinds of stuff going on, right? So last week, and this is February 6th through the 12th, by the way, but last week we had, there was a ton of stuff going on, as you could see. So, and I was really out of pocket with the move. But one thing to note was this unemployment rate from last Friday, which seems like really old news at this point, but where the actual was versus the forecast. So, you would think coming out of a pandemic, and at least as far as the news, haven't paid that much attention to, because the cable systems in both our new office, which I'm going to start broadcasting from next week. Setting up a broadcasting room right off of here as far as our conference room we could do. I'll actually be able to teach going forward on a big whiteboard that we have. So a lot of times I'm best when I'm up in front of the whiteboard just teaching stuff rather than just jumping around showing you guys screens, because I could just mark stuff up and talk about all kinds of fun stuff. But that was last week. Not much going on this week. Let's take a look at the actual charts. This is the S&P. Here's the deep correction I talked about. Take a quick peek at this. So we topped out essentially at this 480 area, approximately 4,800 on the S&P index. We're just looking at the spiders at this point. But if we back out, take a look at the broad market. These are the 500 largest capitalized companies. We topped out at 48.19. Big support, as you may be able to see here at this 42.90 area. We've bounced off it. This is a long-term ledge, if you will. And in all fairness, we were missing a bunch of notches down here, which we came down and filled in. So when you have an incomplete auctioning process, which hard to see, but maybe over here on the left-hand side, you can see how we have like this open area in our profile, which is this horizontal lines right here. These are aggregated profiles of volume of execution throughout the whole period. See how we have sort of a missing notch down here that you may want to, the market may want to auction down to actually get any kind of bounce off of those areas. So that's always an important thing to look at as far as support levels coming into this whole 4,300 area. But outside of that, that's kind of what I see there. Q's obviously been significantly weaker. No surprise, we've had pullbacks in a lot of the biggest names. Typically, the IBD top 50 list, which is sort of like the superstars. Those are usually the ones that have run up the most. They typically will have the biggest pullbacks into these types of runs. So it's not always as positive to see where we want to be. But looking at that, I think it's important to note that as far as at least all of the technology-based stocks that we have set up for the whole situation, the bounces off of this have been weak at best, and the same thing has been the case inside of the Russell 2000. So something to that of note for all of that be the levels that we're holding on to, and the same thing could be significantly weaker. This is always the weakest area in equity land. So just a trading view chart here, daily chart again. I showed a little bit of this on FinViz, but as far as just looking at the trading view system, this is the dollar. See that big pullback. Now, if I actually exit out of this and go and look at a weekly chart, you're going to see that there was significantly more. Let's reset this. Let's take a look at this in a big setting. Big pullback from what looks to me to be the center point. Now remember, there's no volume aggregated on this particular chart, so it's hard to sort of gauge that, but I'm pretty sure that this area here, I'd say maybe within, I don't know, 10 or 20 basis points of this area, was the center line of the entire balance area that you see inside here. Somewhere in this area, as far as volume, you can see how most of it executed underneath the center line, which tells you more than likely the center line is probably right here. So for no other reason, we came up against an area where there was a ton of resistance on a long-term chart. We just completely retraced from it. Just other factors at force other than just the dollar going up to that level and bouncing off. But I think it's important to understand. All right, what else? I don't want to talk too much about this. Here's a euro. So I'll just jump back to the daily chart. Now, in this particular case, you can see that our squeeze zones, which is this orange line at the top, where my cursor is, little crosshair. This was the squeeze zone from a while ago. So this would have corresponded to this particular level on the underside of the dollar chart. It does look like there's actually some notches missing in the profile down here. So I guess from an auctioning process standpoint, it would lead us to believe that we get down and test or complete fill in these notches, which markets typically have a tendency to do in the long term, fill in the notches and then bounce off that area. It's kind of what I'm seeing. As I joke, I could always be wrong. Let's take a look at GBP. This whole 33.75 area of support. Looks like a little bit of a resistance zone here, just up underneath this 3600 area. US CAD daily chart, tight zone as you can see. Top being 2766, support being here, pretty solid support by the way, this 2650 area. Not being that plugged into what's gone on over the last week or so, the only commentary I can really provide on these currencies for now is just kind of what I'm seeing on the charts. As we get back into the swing of things here, provide any insight that I may come across. So this whole 70-35 area. Take a look at Euro GBP. Wakened in Dar from the sleepiness, huh? Crazy. Big moves. Haven't seen this in quite a while. Now, granted, this is just a daily chart, and this was 2 days ago, but that expanded out these squeeze zones. As you can see, that when you have a huge move and a reversal, it's setting up at least a temporary resistance line on the top. Get a pretty solid support here, this 83.10-ish area. Let's take a look at the Neo currency. I haven't seen this in a while. Resistance 72.80 area. Take a look at weekly. Still a big weekly zone, as you guys can see up here. Haven't been anywhere near it. Touched it back towards the beginning of December here at this 67.44-ish area. Let's see what we got here. Open this chart back up. Getting disrupted by phone calls. Here's GLD. Want to just show you this to you guys. It's really tight balancing area here on the dailies. Man, it just looks like to me there's going to be some sort of explosive move out of this soon. Oil got rejected back way up near the highs. supply side shortage thing. Let's take a look at some crypto real quick. Had a pretty big launch into a higher area. Still think we want to see, just looking at the weekly chart on this, still think we're looking to see this whole 20,000 area, which is definitely, it's almost perfectly pinned for our long-term 200-day line down there. Still think that that seems to be the magnet, because a lot of these rallies have been quite weak. So it'd be interesting to see if we get down to this point. But I think a lot of the party's over in crypto, and we could see a pretty big correction. Problem with a lot of these things is that in the case of we've got a lot of calls from different clients saying, hey, there's been pullbacks and all kinds of stuff. But the problem is that you want to see a pullback take place, and then you want to see a good balancing area, and then start to accumulate and volumes start to come on the breakouts. That's the time to buy. There's multiple patterns that fit that type of narrative. So it's just a matter of when it can break out from that point into a solid pattern is the time that you buy. It's not trying to catch a falling knife. I know I seem like a broken record again, but that really is the most important thing. Ethereum as well. Haven't shown this in a while. Pretty solid bounce off this 2200 level. I think that's pretty much it in terms of what I want to talk about. Covered some crypto, equities, bonds, currencies. So any more insights, stay tuned on the Telegram channel. I'll post some good stuff. And as always, watch those weekly calls from the developers of the software. Panther's the new one on the block. We got others coming. Many of them have some pretty solid stability over the last 6+ months, which is great to see. I don't doubt that there won't be some more major volatility moves on a lot of this stuff from a big picture standpoint. Some solace comfort in the fact that many of these have had a pretty decent patterns, and it's always great to see adding new products to the list as far as software that's not martingale, right? And so it doesn't continue to successfully dig you into a deeper hole, which isn't necessarily a bad thing from a risk standpoint. The problem is I just think that a lot of the software, almost all stuff that trades super volatile, instead of just digging a little bit in, right, it should only take the extreme out trades. But hey, that's just me. I've always taught students to take the extreme outs when you're standing in front of the freight train, right? Always easiest to trade with the trend and catch that train as it's leaving the station, right? Then stand in front of it. But as I always say, I could be wrong. Hopefully not. Wish everybody a great trading week. I am Steve Vettel, signing off. May the trade.
There is a substantial risk of loss associated with trading Forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.